the underlying asset or to lock in a purchase price for the asset on some future date. Speculation, it is attempting to profit from an expected increase in the price of underlying asset. Risk management, it is locking in a future price for the asset. Why investors sell future contracts? Investors sell future contract to profit from a decline. So buyers profit when price goes up, sellers profit when prices decline, or to lock in the sales price of a particular asset on some future date. So speculation is attempting to profit from an expected fall in the price, and risk management is locking in the future price for an asset. Now, exchange traded and OTC derivatives. Derivatives trade either on an organized exchange as exchange traded derivatives called as futures, or they trade off an exchange called as over the counters or forwards. OTC network is dominated by banks and financial institutions who trade directly with corporate clients and other financial institutions. When a forward-based derivative trade on an exchange, it is typically called a future contract. Now this is difference between exchange traded and OTC. So exchange traded, that is futures, they trade on exchange. OTC contracts trade through computers and or phone lines, so they trade majorly on the dealer network. These are standardized contracts, so standardized in terms of quantity as well as quality. OTC are extremely customized, so you can decide, which means both parties can decide what to buy and sell. These are transparent, these are private because numbers are shown. How much trading of future happen is generally visible. Forwards, no one knows how much trading happens because they are private. Easy termination is possible before the contract expiry because you can sell your obligation on secondary market, right? You can get into a counter trade. So if you have bought futures, you can sell futures to balance out. If you have sold futures, you can buy futures to balance out. But on OTC, termination is more difficult. Clearinghouse is the third party. So clearinghouse guarantees the trade. There is no third party. Performance bond or good faith deposits are required. So you have to deposit initial margins to trade in futures. There is no performance bond or good faith deposits. Marking to market, so profit and loss are adjusted each day. Profit and loss are settled at the end. These are extremely heavily regulated. There is not much regulation in OTCs. Delivery rarely takes place, so mostly they are cash settled. So if I am losing, I pay in cash. If I'm gaining, I get paid in cash. And OTC, delivery can happen or final settlement can happen. Then in exchange traded, commissions are visible. In OTC, fees are built into the price, they are not explicitly visible. Exchange traded are majorly used by retail investors, corporation and institutional investors. OTCs are majorly used by corporations and financial institutions. Now underlying assets can be anything. It can be commodities like wheat, corn, soybean, sugar, cocoa, coffee, crude oil, natural gas, propane, copper, aluminium, silver, platinum. Major volumes are there for oil. Financial assets can be equity stocks as well as equity indexes. More volume for equity indexes vis-a-vis stocks. They can be interest rates or they can be currencies. Uses of derivatives, so there can be different users. Individual investors, so small retail investors can speculate on derivatives. There can be institutional investors like pension funds and mutual funds and hedge funds. There can be business and corporations who buy currency derivatives or interest rate derivatives because they're covering their risk, or there can be derivative dealers. Why derivatives are useful? Because it helps to reduce risk. So example that we took in terms of India means in terms of China and Canada. So China was reducing the risk of oil prices going up and Canada was reducing its risk of oil prices going down. So hedging is an attempt to reduce or eliminate the risk of either holding an asset for future sale or anticipating a future purchase of asset. Hedgers start with a pre-existing risk that is generated from normal course of business. Hedging is accomplished by taking a counter or opposite position in the derivative instrument of the asset to be hedged, or one that is very close to it. Then you can also use derivatives for market entry and market exits. Sometimes it is very difficult to buy stock or sell stocks. So if you want to take advantage of price going up or down, you can easily do it in futures rather than actually selling and buying stocks. Then you can enhance your yield. So you can bet and increase your yield, or you can arbitrage. So buy in one market and sell in another. Next is options. Options are contract between two parties, a buyer and seller. Buyer has the right but no obligation to buy or sell a specified quantity of underlying asset in a future at a pre-agreed price. Seller is obligated to complete the transaction but only if buyer executes. Primary difference between options and forward. An option holder has the right, while forward holder represents an obligation to buy or sell in future. Option have a trigger point known as the exercise price, above or below which it has an expiration. So trigger point means the price is set at what price you will buy or sell. Forwards has no trigger point, they develop value as soon as market price changes. The price of option requires purchase of option requires an immediate payment, so you have to pay premiums to buy options. No money needs changing of hands when you buy and sell futures or forwards. Option terminologies. So there is a writer, the seller of option who is obligated to act. Then there is strike price, the fixed price at which rights given to buyer can be exercised. Expiry, the month the contract expires, usually Saturday following the third Friday after expiration. Contract size, they are generally traded in multiples of 100. Premium, the price paid for option, so buyer pays premium to writers. American style option, an option that can be exercised anytime up to and including the expiration date. Most of the options are American, so that are traded on stocks. European style option, an option that can be exercised only on expiration date, so you can execute only when the expiration date is there. Within that time you cannot execute. Buyer or holder, the holder of option with right but not with obligation. Opening transaction, buying or selling an option to initiate a position. Closing by offsetting, exercising or expiring worthless. So you open a transaction by buying an option, but there are different ways to exit. First is, you can, if you have bought a call option, to counter it you can sell a call option to close. Then you can exercise if you are in profit, or you can let it expire worthless, so your premium goes away. Long position, the buyer or holder of option is called a long position. A short position is the seller or writer of option. Assigned is when long or the buyer executes the trade, that is exercise his option. Intrinsic value, the value of certainty, the in the money portion of call or put. So if you are making profit in option, if the price goes above your exercise price, then the options are called as in the money. If price is below the exercise price, then they are out of the money. Time value, the value of uncertainty, the amount an option is trading above its intrinsic value. So when you see the premiums that you pay, generally part of it is because the options are in profit, and part of it is because of time value, that is uncertainty. Types of option, there are calls and puts. So call gives holders right to buy and writers have obligations to sell. Put has holders right to sell and writers have obligation to buy. So option position, so call buyer pays premium, call writer receives premium. Call option is right to buy the underlying asset. Call writer is obligation to sell at a fixed price. Put option is right to sell. Put option pays premium. Put writer receives premium. Put writer has obligation to buy. Options generally have leverage. So example, suppose you believe the price of company stock was going to rise from 50 to 75. You can purchase 100 shares or an option contract. So they are giving you examples. If you buy 100 shares at 50 and the stock goes to 75, you make profit of 2,500. But let's say one call option contract is at $5. So you buy one contract by paying $5 per stock into 100 stocks, that is $500. And when the price goes to 7,500, you make a profit of 2,500, but you have already paid 500, that is not returned to you. So you make profit of 2,000 by paying only 500. So percentage profit is more. Option risk, a call option buyer can only lose premium. Option writer has loss of big capital. So unlimited loss if writing a naked call. So we'll discuss what is naked call and what is a covered call. Put option buyer loses premium, but put option writer can make a large loss if price falls heavily. So writers have more losses, alright? Buyers just have premium that they lose. Option valuation. So call option is in the money if market price is above the strike price. So let's say your execution price in Facebook was 140, but the market price is right now 160. So your option is in the money. So if market price is greater than strike price, your option is in the money. If market price is less than stock price, if price is, let's say if it is a put option and price is 120 when the exercise price was 140, then you are in profit. So for call options, they are supposed to be in the money when market price is greater than strike price, and put options are in the money when market price is less than stock price. Out of the money options, so call options are out of the money when market price is less than stock price, and put options are out of the money when market price is greater than stock price. So you will not make any profits if price goes down. So that's why market price, if it goes down than the strike price, you make losses. So you're not making any profit. Intrinsic value, the in the money portion of options price. Time value is option premium that you pay minus the intrinsic value. Option pricing, intrinsic value is market price minus strike price. Put option, it is strike price market minus market price. So this you have to remember. For call option, it is market price minus strike price, that is in the money part, and put option, it is strike price minus market price, that is intrinsic value. Time value is always market value of the option, that is premium that you paid minus intrinsic value. Example, they have given XYZ 50 call. XYZ company's December 50 call is trading for 7.25 when the stock price is 56. So it's a call option. So price is 56, you can execute at 50. So are you in profit? Market price is 56, you can buy it at 50. So you're in profit of $6. $6 is intrinsic value. But how much is the option trading at? Option is trading at 7.25. So 7.25 minus 6 is time value. So intrinsic value is how much profit are you making. Time value is how much have you paid above the profit. The option is in the money. Okay. Same way, June put is trading at $4.85. Execution price is 25. So you can sell at 25. And the market price is 21. So are you in profit? Yes, because everyone else is selling at 21, you can sell at 25. So you are in profit of $4. Intrinsic value $4. Time value, how much did you pay? 4.85. What was the profit? 4. So 85 cents is time value. It is in the money option. Okay. So option expectation. So call buyer generally thinks that price is going to go up. Writer thinks price is going to go down or there is no change. Put buyer thinks that price is going to go down. Put writer thinks that price is going to go up or there is going to be no change. Why do we use call? Buyers use call for additional income by buying the stock or reducing the net cost of money. Means why do we use call? So additional income or greater leverage, and writer use it for against buying the stock. So I'll explain it once we discuss covered call and put. And also to reduce the cost of the investment or locking in the future price and protecting a short, you can use for call. So this is important. Call writing can be covered or naked. So what is a covered call writing? So you have shares and you write the call. That is a covered call writing. So what you do, based on the amount of shares you have, let's say you have 100 stocks of Facebook which are priced at 140. So you have $14,000 worth of Facebook stocks. Okay. And then you, or $140,000 worth of Facebook stock, and then you write a call option. So writer owns the underlying share. So if you are assigned, you sell the stock and you give money to buyer. You keep the premium if you're not assigned. So if buyer doesn't execute, you keep the premium. If buyer executes, you sell your stocks and pay him. So you have less risk. You may be able to lock in your profits. Naked call, writer does not have any underlying stocks, right? But you still write. So if the buyer assigns you, you have to pay from your own pocket, and it can be a large amount. So it's a highly speculative position. If assigned, must purchase the securities at higher price, then sell them at a lower strike price. So you can make a large loss. Why can you use put? So holders use put for earning additional income. Then there is lesser risk, and you use it for acquiring stock at a net price. You look at the future price, right? Protecting an existing position. So all of these are uses of put. Put writing also, it is cash secured or naked. Cash secured means writing a put. So you have put options, you're writing a put and setting aside cash. So whatever cash is required, you set it aside and then write a put. Invest in short-term liquid money market instruments like T-bills. If assigned, you buy the shares and give it and sell it. Naked put, no position in stock, no cash set aside to purchase the stock. It is highly speculative and you want the price to remain at or above the strike price. If it falls, then you are in huge losses. So summary of options. If you are a buyer, your belief is stock price will rise. You will exercise or sell if the price rises. Your risk is lose cost of investment, that is premium. Put option, your belief is stock price will decline as a buyer. You will exercise or sell if the price falls, and your risk is you may lose the premium. As a writer of a call option, the stock price will decline, that's a risk that you have. Your action is none, or you can buy back the option. Your risk is you must sell stock at the strike price no matter what the price is. Put option, stock price will increase is your belief. You take action of none, or you can buy back options at a later date. Your risk is you must purchase the stock at strike price. Next is write warrants and option. Write warrants and call options share certain characteristics. Each gives the holder or buyer the right to purchase additional stock at a specified time until expiry. So how do they differ? So first is right. Right is a privilege granted to existing shareholders to acquire additional shares directly from the issuing company. So issuing company to raise capital by issuing additional common shares, a company may offer shareholders the right to buy additional shares in direct proportion to the number of shares they already own. So what is right? if I have certain shares, the company can issue me rights. That is, in future, I can buy the company's share at X price, irrespective of market price. So it's like call option. I get the right to buy, but there is no obligation. For example, the offer may be based on right to buy one additional share for each 10 shares that you have. So again, there is a period of come right and X right period. So come right period means stocks are trading with rights, and X right periods means the stocks are not trading with rights. So value of right options in come right period is X minus X divided by N plus 1. That is value of right in come right period. So it is stock price minus the exercise price, how much price it is above, and you divide it by N plus 1, whereas N is number of rights required to purchase one new share, and in X right periods you divide it by N. Now this is an example of how it works. So ABC Inc. declares right offering. Shareholders of record as on Friday 16th July were granted one right for each share that they have. 5 rights needed to subscribe for each new ABC share at a price of 23. The rights expired at the closure of business day on 18th August. So share price were given as follows. So these are the share price on different dates. Record date was 16th of July and you can buy the share at 23. So when will share begin to trade X rights? So it's same as dividend. One day before the record date, stocks start to trade X right. So all these are come right shares and all these are X right shares. Okay. Next is what is the intrinsic value of right on the last day of come right. So you can use the formula. And what is the intrinsic value on first day? Same, use this formula. Difference is come right, you have to divide it by N plus 1. And in X right period, you have to divide by N. So S minus X divided by N plus 1 in come right, and S minus X divided by N in X right, where S is strike price, S is market price. So market price is these prices and X is execution price, that is 23. So it will be 26.50 minus 23 divided by N plus 1 because it's come right. And from here on 15th onwards it will be X right. Next are warrants. So warrants provides the holder with an option to buy shares in the company from issuer at a set price for a set period of time. So warrants are exactly like options, but they are long-term options. Warrants are often attached to new debt or preferred issues. So they are exactly like call option. Call option gives you right to buy. So let's say you get a right to buy Facebook stock at 140. Same way, if a warrant is issued, you get right to buy Facebook stock at 140. Whatever is the price. If price is even $200, you will still be able to buy it at 140 if you hold a warrant. Warrants are often attached to new debt and preference issues to make these issues more attractive to buyers by giving the buyer of a new issue the opportunity to participate in capital gain. So intrinsic value is easy. So warrant entitles the owner to buy one stock at a price of 40. The warrant has a market price of $5 and the shares are trading at 42. So what is intrinsic value? So are you profitable? So you can buy shares at 40 when the price is 42. So you're profitable. How much? $2. So intrinsic value is 2. Now how much did you pay to buy this warrant? You paid $5. So time value is 5 minus 2. That is $3. Assume that in this case the common share trade at 35 per share. So There will be no intrinsic value because 35 minus 40 is 0. Time value will be $5. That's it. I would urge you to watch this recording once again and read the book carefully. This is an important chapter and it's a difficult chapter. Hello everyone and welcome to this recording. This is actually chapter 11 now, so they have switched the chapter. So we are going to discuss corporations and their financial statements. Now I'm really sorry that I haven't been able to record these video a bit earlier. I have been busy with a lot of project work and some consulting work also, so I was not finding much time to do it, but better late than never. So let's start. So in this chapter, we are going to discuss financial statements and how they provide a wealth of information, how they can help to gauge the performance of a company. Now, the important point is in Jan 2011, Canadians started following IFRS. We used to follow GAAP, generally accepted accounting practices, and we moved to an international system called as IFRS. Now each reporting that happens for a company, it follows IFRS rather than GAAP. Now the major difference between what we used to follow and what we follow right now is GAAP is rule based. So there are certain number of rules that you have to follow and you have to follow it in black and white. Now IFRS is principle based, it's not rule based. So the biggest advantage that you have in IFRS is the flexibility. So you have to follow a certain principle, but you have the flexibility of deciding how to present it. And you have to give disclosures of how you are presenting it, but you have enough flexibility there. And IFRS also makes it easier to compare. So now we can compare a Canadian company with a US company and simultaneously compare it with a European and an Asian company if all of them are following the same accounting standards. Then there are three types of business structure that the book talks about. So first is the sole proprietorship, partnership, and corporation. So what is sole proprietorship? I'm a person, so an individual or a family starts a business, and business and their personal affairs are not separate. So they are running business as a family or as a sole proprietor. So in that case, so there is no distinction between the business and their personal life. So they have more liability. So if what happens, what do I mean by more liability? So if a creditor sues the business, they're indirectly suing the person. So there is no separation between the person and the business. So sole proprietorship is an individual or a family starting a business. Second, there is no separation of business between business and the personal affairs. Third, if you get sued as a business, then your personal assets are online. Okay, partnership is two or more partners coming together and starting a business. Now there are two types of partners that are involved. So one is the limited partners and one is the general partners. General partners are responsible to run the business, so their personal assets are online when the business operates. Limited partners only come in as an investor, so they are only responsible for the amount of investment that they put in. For example, if you watch Dragon's Den or Shark Tank, so whenever Mark Cuban or Kevin, or even in the Canadian one, the Dragon's Den one, if let's say Manjeet is investing, so if they are investing in businesses, they come in as a limited partner. That is they don't come in as a general partner, they come in as a limited partner. So they are only liable for the amount of investments they are making, 50,000, 100,000 that they are putting in. They are not liable beyond that. But the person who is running the business is the general partner, so he or she is liable beyond what they have invested. Corporations is where you form a separate legal entity, and so there is separation of management and there is separation of shareholders. So people who own the business and run the business, there is a distinct separation. Second, corporation is a legal separate entity from investors. So investors at any point of time are not liable beyond what they have invested. So if I am a shareholder and I buy Apple stock for worth, let's say $200, and Apple goes bad, means Apple does some bad things and it goes into debt, and Apple has, let's say, $400 of debt per share and it is closing down, I am not liable for that. I invested $200. I'm not going to get that $200 back. So my loss is limited to the amount I have invested. I cannot be sued for my personal asset because Apple is getting bankrupt. So sole proprietorship or a single proprietorship, it means a business is owned by one person who operates it for his or her own profit. Advantage, you are your own boss, all profits go to the owner, it is easy to establish, there are certain tax advantages. So it is much easier to establish a sole proprietorship. It means forming a partnership and corporation is more hassle. Corporation specifically is more hassle because you need to develop the charter and all those things. Then there are certain tax advantages. For example, there is no double taxation when you start a sole proprietorship. Example, if I am an investor in Apple, so whatever profits that Apple makes, it has to pay tax on it. Then whatever it distributes to me as dividends, I have to pay tax on it. So I am taxed twice, one on the profit that the company makes, then what the profit that the company shares. So corporations have double taxation, but if I run business as a sole proprietor, then my business and my personal affairs are intermingled, so I don't have to pay tax twice. Disadvantage is it has unlimited liability. My personal assets are online when I start a sole proprietorship. There is limited management ability. So I may be good in sales and marketing, but I lack the administrative part of the business. So I may suffer because of that. There is limitation on size, and there are certain tax disadvantages also. There are a lot of expenses that a corporation can claim for tax purposes that are not allowed when you run it as a single proprietor. What is a partnership? A business that consists of two or more owners doing business together for profit. General partnership, there are two types, general and limited. General partnerships are involved in day-to-day operation of the business. The risk is shared equally, that is, each partners have unlimited liability. Limited partners, they come in only as investors. So always try to visualize Shark Tank or Dragon's Den. Cannot participate in day-to-day operations of the business, and liability is limited to the amount of investments. Advantages of partnerships, it's easier to set up than a corporation but more difficult than proprietorship. Can usually raise larger sum of capital than sole proprietorship. You require you have more management skills because you can take in a partner who is not who complements your skill. Disadvantages, there can be a lot of conflicts. There is unlimited liability, especially on general partners. Then it has limited life. Partnership or sole proprietorship dies with you, with the founding partners. So if I start a business as a sole proprietor and if I die, then the existence of business comes into question, right? Same way, if I start a partnership and if the partners are dead, so the business doesn't continue. Then it has a possibility of limited growth. Corporations, it is a legal entity that is separate and that can be sued, can be part of contracts, acquire property. Companies can be incorporated either federally or provincially. Most of the companies are incorporated provincially rather than federally. A corporation that has one or more classes of shares publicly traded is called a public corporation. Private is a closely held company with limited number of shareholders. Generally, a rule of thumb is 50 or less. Advantages of having a corporation, you have limited liability. This is important. Shareholders cannot, I repeat, cannot lose more money than they have invested. Continuity of existence. So shareholders are separate and the company is separate. So even if let's say it's Apple, Steve Jobs means unfortunately died, but the company is still in existence, so there is separation of that. Transfer of ownership is there. Then there is ability to finance. There is higher growth potential, so companies can raise lot of money from debt, from preferred shares, from international markets if they are formed as a company. Then there is legal entity. It's a separate legal entity and you can hire professional management. Disadvantage, there is less flexibility. There is double taxation when you share your profits with shareholders. There are a lot of expenses, means you have to have higher reporting, then you need to, the incorporation expenses are more, and there are capital withdrawal restrictions. For example, I cannot force Apple to give back my money if I am a shareholder, right? Apple can have a share buyback, but it is totally up to Apple. I cannot force Apple to pay back my money to them. Important terms, so corporate bylaws, voting rights, shareholders meeting, voting by proxy, and voting trust. So these are some important things. So corporate bylaws means when you form a company, you need to have certain laws, means certain ethics and laws that you build into it. So these are called as corporate bylaws, and they are formed when you start a company. They are written into the charter of the company. Voting rights, each shareholder gets voting rights. There are certain shares that have limited voting rights. Preferred shares do not have voting rights. Debt do not have voting right. There is a condition to it though. If preferred shares are not paid dividends, they may be given voting rights. Shareholder meetings, so shareholders generally vote on restructuring the company. They vote on major company decisions. They vote on, means, appointing a board of director. So all these things are decided by shareholders. How do they decide it? They go to a shareholder meeting and vote. Now, voting by proxy, if you're not able to attend that meeting, you can assign your voting rights to someone else. Let's say some person in the company's management, and the company's management will vote for you. So you decide what you want to vote. Let's say company is going to merge with some other company and there is a shareholder vote out for it. Then they will send you letters and you can tick on letter whether you want the company to merge or whether you don't want company to merge, and then it is forwarded to management and the management puts it in when the vote actually happens. That is called as voting by proxy. Voting trust, so when a company is undergoing some restructuring, the debt holders may force shareholders to deposit their shares and their voting rights in a trust so that they cannot interfere with the restructuring. So that is voting trust. It happens only when restructuring of a company occurs and debt holders do force it on shareholders. Corporate structure, so there are directors, there are shareholders who own the company. They appoint the directors. Directors are representative of shareholders who oversee management of the company. Then these directors vote on the chairman. So this chairman is head of board of directors. Then there is president who runs the company, also called as chief operating officer or chief executive officer, sorry, not the chief operating officer, CEO. Then this CEO appoints different presidents who run the company, and then there are officers there that are third parties like the auditors and all, okay, who help run the company. Importance of financial statement. Financial statements are, it's a way of communication between company and between the management and shareholders. So management run the business at a given interval, at a specific interval, generally quarterly or semi-annually or annually. They communicate how the business is performing with shareholders. So it is a way of communication from management to shareholders. Now they are important because financial statements are an indicator of financial health of the company and thus the potential performance of the company's securities. Knowledge of company's present financial position and its past earning is needed when selecting securities. So when you decide to invest in a company, you need this information. Combining this information with an understanding of industry, the economy in general, and the specific plans and projects for the company helps you to make investment decisions. So financial statements are important for existing investors as well as potential investors. Now there are four financial statements. So statement of financial position, also called as balance sheet. So balance sheet indicates how much the company has in assets and how much the company owns in, means owes to others in liabilities, and what is the remaining equity that the shareholders have in the business. So it is financial position of a company as on a given date. Statement of comprehensive income or the earning statement or income statement, it shows within a given period how much has company performed in sales, what are the different costs that it has incurred, and what is the profit that the company has left for shareholders. So it flows from sales, costs are reduced, interest is deducted, taxes are deducted, then whatever is left is the profit, net profit that goes to shareholders. Then it is a period statement, it is not a point statement. So within a period how much you have performed. Then there is statement of changes in equity, previously called as the statement of retained earnings. So it shows how these profit flow into the balance sheet. So if a business is generating profit, then out of those profits, out of those cash flows, how much it is sharing with the shareholders and how much is being retained into the business. Statement of cash flows, so cash is separate from profit, so it shows how much cash is coming into the business and how much cash is going out of the business. So let's start first one by one. Balance sheet or statement of financial position, it shows the financial picture of a company as at a single point of time. It represents a certain snapshot of the company at one particular point of time. So what the company has, also called as assets, and how they got it, that is the liability. Shows what the company owns in form of assets and what it owes in form of liabilities. Now this is a very famous equation, assets equals to equity plus liability. Now when we do accounting, we follow double entry accounting system. So each accounting entry has two impacts, one on the left hand side and one on the right hand side. Left hand side is assets, right hand side is equity and liability. So any sales you do, any entry you do in accounting, it will have two impacts, one on assets and one on either equity or liability or both. And that's the reason it is called as balance sheet, because left hand side and right hand side always balances. So asset is equal to equity plus liability. Now in exams they may ask that do assets and liabilities balance? No, because there is also equity in there. So assets and liability don't balance. That's why we have equity in the business. If equity is zero, then assets are equal to liability. So generally balance sheet has total assets. So assets are again divided into current assets, non-current assets. Then there it has total equity, total liabilities, and the addition of equity and liability, that is the right hand side, total equity and liability. Now assets are divided into non-current assets, example property, plant and equipment, then goodwill and investments in associates. Now what is goodwill? So first is evident, whatever factory, machinery, then land and whatnot the company owns, it is all its assets. Then goodwill is when a business pays extra money for acquiring something, that extra money is taken as goodwill. For example, a company is buying out some other business, some small business, The share price of the business is $50 per share in the market. But since the company is acquiring a controlling interest, it is paying $55 per share. So how will that accounting work? $50 will be treated as capital when the company buys it out, and $5 that it is paying in addition becomes goodwill. Same way, if you are acquiring patent, some patent that some XYZ individual has, and you are a pharma company, you are acquiring that patent. So if the patent is $1 million and you are paying $1.2 million for it, then this extra 0.2 million that you pay becomes goodwill. So goodwill happens when a company pays extra for something that it buys. Then there is investments in associate. Now how it works? So if I own a majority of the business, so if I have 70% of equity in my subsidiary, so example, I'm a Canadian company, but I also do business in States. Now in States, I have formed a separate company to do business, and I have a separate company in Canada to do business. Now, if I own, like, let's say 70% of the company in United States, then I will combine the financial statements when I show it to the investors. So all the sales that are done by US and Canada will be combined, all the cost will be combined, and you will have a profit that is combined. And same, but I will show a deduction of what I don't own. So 40% of the business I don't own, 60% I own. So this 40% I'll show it in statement of equity, that is means the part that I don't own. Same way, I will take deductions in income statement for non-controlling interest. So this happens when you own a significant part of the company. When you own significant part, you combine the financial statements and take two deductions. One is an income statement and one is in balance sheet, also called as statement of equity. Now, if you don't own a majority, you own only small part of it. Let's say I have only holding of 20%. I don't have 60% holding. I just control 20% of the American company. The rest of it is controlled by investors. Now what do? Now I don't combine my financial statements. What I show is, I show investments in that subsidiary. The 20% investments that I have, let's say the business was 100 million and 20% becomes 20 million. So this 20 million, I show it in assets. Then 20 millions of the profits that I get from the business, I'll show it in income statement. So I don't combine my business and I don't take deductions. I show only part of it. Okay. Current assets, you have inventories, prepaid expenses, trade receivables, cash and cash equivalent. So current assets are assets that can be easily converted into cash. So inventories, prepaid expenses, trade receivables, and cash equivalents are current assets. Sorry for that. Okay. So property, plant and equipment, these are called as capital assets. Capital assets consist of land, building, equipment, tools, etc. These are used in daily operations of business. They are generally not for resale. They are carried at cost. So whatever you have invested initially and you amortized it or you depreciate it. So cost less amortization, except land. Land is never depreciated, it is never amortized. It is always carried at the cost at which you buy it. So there are three concepts: amortization, depreciation, and depletion. So what is this? If I invest in a factory, so if I put in $100 million to construct a factory, so what do? I don't show that entire 100 million of expense in year one that I constructed it in. I distribute that expense over a period. So how would that work? I create an asset of factory 100 million and each year I deduct part of it and show it as expense. So that is called as depreciation. Same way, amortization works on intangible assets. If I acquire some patents, some copyrights, I have to amortize it. Same, depletion works on things like mining or petrol, means crude deposits and all those things. So if I'm working on oil sands and I have a lot of deposits, each period I will be taking out certain deposits, means I will be making some barrels of oil. So those barrels deplete the assets that I have. So depletion works on mining, on oil and gas, on technology, etc. Amortization works on non-tangible assets, and depreciation works on tangible assets. A normal cost of doing business to record the ordinary wearing out of the firm's capital assets and write off to intangible assets is called as depreciation. That is an annual allowance for depreciation, amortization, and depletion. It appears as a non-cash expense because it's non-cash. You have already spent for it. You're just showing it later on. So that's why it is a non-cash expense in the statement of comprehensive income. Depletion is similar to amortization, as it's usually used by mining, oil, natural gas, timber companies, and other extractive industries. Example of depreciation: an $100,000 piece of equipment is purchased. The firm believes that the equivalent equipment will have a useful life of 10 years and a residual value of 0. So there are two ways you can depreciate it. One is declining balance. Each year you depreciate 20% irrespective of how much life it has and all those things. So straight line balance is different. The formula for straight line balance is cost 100,000 minus residual value, that is 0 in this case, divided by the useful life, that is 10 years, that is 10,000. So this is how a straight line method works. So 100,000 minus 0 divided by 10. 10,000 is claimed as depreciation each year. This is how a declining balance works. Example: 20%, that is 20,000 you will take in first year. Then 20% of what is remaining you will take in the next year. 20% of what is remaining you will take in the next year. So depreciation keeps on reducing. Now there are significant impacts. If you use double declining method, the profits will be lower in initial years, profits will be higher in the later years. Depreciation is a cost. So can you see, depreciation is higher in the initial years and it keeps on reducing. So profits are lower in the initial years if you use double declining, and profits are higher in the later years. If you use straight line method, profits are constant, means the depreciation is constant, so there is no impact as such because of depreciation on profits. Capitalization: it is recording an expenditure as an asset rather than an expense, so that the expense can be spread out more evenly than one accounting period. Goodwill and other intangible assets. Goodwill is often defined as the probability that a regular customer will continue to do business with it. Goodwill is created when you pay more than what you are acquiring the asset for. Intangible assets lack physical substance. These includes patent, copyrights, trademarks, and franchises. How is goodwill created? When you pay more than the cost. Investments in associate: the degree of ownership a company has in other companies. It has significant influence, is presumed to exist when a company owns 20% or more. Current assets: cash or other assets that will be realized, consumed, or sold in the normal course of business, normally within 1 year. So these are inventories, prepaid expenses, trade receivables, cash and cash equivalent. The key measure of liquidity to accessibility to meet day-to-day expense. These are current assets are used for day-to-day expenses. And if you run out of current assets, then you are screwed, because then the financial viability of the business becomes an issue. Current assets: the large portion of current assets is inventory. So goods and the supplies the company keeps in stocks. It is valued at original cost or net realizable value. So original cost, or the price that you get when you sell it in the market, whichever is lower. There are two ways used to account for inventory. So how it works? So you buy raw material, you keep it in inventory, and then you use it for cost of goods sold when you do sales. So for example, I am a distributor. I am buying wine that has constantly changing prices. So I'm buying wine from my French producer, then I keep it in my inventory and then I sell it. So the cost that is assigned, it depends on the method I'm using. There are two ways to do it. First is first in first out method. So whatever wine I'm buying first, I'll use it for my COGS first. So let's say I am buying the same bottle of wine but at two different prices. One I am buying at $20, the other one I am buying at $25. In first in first out method, first sale I do, I'll allocate $20 to it. The next sale I do, I allocate $25 to it. So this happens in first out method. In weighted average, I don't do that. In my inventory, I calculate the weighted cost of my inventory. For example, I am buying 20 and 25. So 20 plus 25 divided by 2, that would be my cost. And the same cost I will allocate. Now there are implications of doing this. If the prices are rising and if I use FIFO, first in first out, then my profits will tend to be higher right now. Profits will be lower in future. Okay, because my COGS will be lower because I am allocating less priced goods initially, then higher priced goods later on. So my profits are higher if I use FIFO, but my inventory has lower value if I use FIFO. Okay, my inventory has higher value, sorry, my profits are higher, the inventory cost is also, the inventory cost that I carry is also higher. Now if I use weighted average, opposite, profits are lower in case of rising prices, as well as inventory cost is also, inventory value is also lower. So two impacts you have to remember. With FIFO, when we use FIFO for accounting for inventory, the profits are higher if the prices are rising, if profits are lower if the prices are falling. Okay, second, the inventory value that we carry is also higher if prices are rising, inventory value that we carry is lower if prices are falling, and vice versa for weighted average. If the prices are changing, each of these methods produce a different inventory value and a different profit. When the prices are rising, so FIFO produces the higher inventory value on the financial position. Prices are falling, FIFO produces lesser value. Next is prepaid expenses. These are payment made by company for services to be received in future. For example, paying the rent in advance, that is a prepaid expense. So you are paying rent right now for future period, so you don't have to pay rent in future. Trade receivables, money the company owns for goods and services it has sold. So if you are selling on credit and the customer has to pay you back, then it becomes a trade receivable. So you are going to receive cash in future. Equity includes but is not limited to share capital, retained earnings, and non-controlling interest. Share capital is the initial capital I have issued. Then retained earning is how much profit I have made in past, including today. So the total profit that I have in my kitty, total profit that I have retained in the business. The dividends that I pay decreases the retained earnings. So total profit that I have retained in the business is retained earnings. Non-controlling interest is a deduction. So for example, if we have taken 100% of assets, but some part of those assets I don't control, someone else controls, then I take a deduction. Then liabilities, you have non-current liabilities, for example long-term debt and deferred tax liabilities. Deferred tax liability means if I'm paying less tax now but I have to pay more tax in future, then I create a deferred tax liability. It happens because companies generally follow two different set of accounting practices, one for the corporate reporting IFRS and one for the tax purpose. Because of that there are discrepancies. Sometimes you pay more tax, you create deferred tax assets. Sometimes you pay less tax than what is required, then you make deferred tax liabilities. Current liabilities, these are current portion of long-term debt, current tax payable, trade payables, and short-term borrowings that the company has. Deferred Deferred tax liabilities, these represent income tax payable in future period, commonly results from temporary differences between the book value of assets and liabilities as reported on statement of financial position and the amount used for tax. The reason, you use different accounting standards, one for tax, one according to IFRS. Company will take the difference between the two amounts and multiply it by future tax rate to achieve at the amount of deferred tax liability. Next is statement of comprehensive income, shows revenue and related expenses for the period ending at a specific point on time, shows adequacy of earning to assure successful operation and provide income for holders of its security. The earning power and cash flows are of primary interest. So this is how it generally works. So revenues less cost of sales, that is direct cost, gives you gross profit, plus other income that you have generated, less distribution cost, less administrative cost, less other expenses, less finance cost, plus the share of profits from associates that you have, less income tax gives you profit. Example they have shown, so revenue, cost of sales gives you gross profit, other income you add, so the rest of the cost like distribution cost, admin cost, other expenses, finance cost you deduct, you add share of profits from associate, income tax you deduct, it give you profits. Key items in income statement: revenue, it is income from selling its main product or service. Cost of sales, an expense which goes directly to the cost of manufacturing a product. The cost of goods purchased for resale. Other income, it is not directly related to company's normal activities, dividend and interest received from investments. General expense, it is distribution cost, salaries and commissions that are paid to sales professional and for advertising. Administrative cost, office salaries, accounting staff salaries and office supplies. Other expense that you incur, expenses not directly related to company's normal operating activity. Finance cost, the interest that you pay to debt holders. Share of profit of associate, proportionate share of profit when the company has significant influence without control, so less than 51 but significant influence. Income tax expense, the payment you make to the government. Also includes deferred taxes. So statement of changes in equity shows the extent to which profits are distributed to shareholders and retained. So how it happens, the formula is beginning retained earnings plus the current term's profit minus the dividend gives ending retained earning. So how much profits you had retained in the business plus the current profits that you have made in the period minus the dividends that you have paid gives you the ending retained earnings. Next is statements of cash flows, shows how cash was generated and spent during the year, identifies sources and uses of funds in operating, investing and financing activities. It is used to evaluate the company's ability to generate cash for reinvestment, to repay debts and pay dividends. Okay, so cash flow means how much cash is generated in the business and how much cash you pay to outsiders. There are three parts of cash flow statement. Cash flow from operating, how much cash you generate by operation of the business. Cash flow from financing, how much cash you bring in from investors and debt holders and how much you give them back. And cash flow from investing, how much cash you invest and how much cash is returned to you from those investments. Operating activities begins with company's profit and it is adjusted for items such as depreciation, amortization and share of profits of associates that do not involve an outlay or receipt of cash. Financing activities includes proceeds from issuing shares, funds received under long-term debt issues, repayment of long-term debt and payment of dividends. Investing activity consists of outlays of cash to acquire capital assets, receipt of cash on disposal of those assets, dividends that are received from associates. Now, apart from that, there are annual reports. So notes to financial statements and auditor report is also appended with financial statements. Note to financial statement means they explain the financial statement, how they were created, and the auditor report certifies that to the best of his ability, the financial statements are true. Now there are audited and not audited financial statements, unaudited ones. So you have to be careful which ones are audited and which ones are not. Public disclosure and investment rights. So annual audited statements have to be filed within 120 days of closing of business on TSX Venture and 90 days on the Toronto Stock Exchange. So if you're listed on TSX, you have 90 days after the close of your year, or 120 days if you're listed in Venture Exchange. Unaudited quarterly reports, you have 60 days time if you're a Venture Exchange, if you're listed on TSX Venture, 45 days if you're on TSX. There are certain rights for investors. Right of withdrawal. So within 2 days, if you have bought shares from some company, not on the secondary market, from the company in an IPO, then you have 2 days to withdraw your offer. Then right of recession, if you find that you have been there was some significant portion that the company lied about in the prospectus, you have a right of recession. You can take your shares back, you can take your investment back, and you can also sue them for damages if there is significant misrepresentation. Now there are takeover bids. If you are acquiring more than 20% of any business, then you are considered to do a takeover. Then you have to disclose it. Early warning, if you are you have started to acquire more than 10% of the business, then also you have to disclose it. Insider trading, a director or senior officer of the company or a subsidiary is trading. If you have more than 10% of ownership, then also you are called as insider. A director of a company who has more than 10% ownership in a company is also an insider. And also a reporting body, like if an auditor has some shares, or if an investment bank who is doing an IPO has some shares, these are called as insiders. There are certain restrictions that are placed on insiders. Now, who are insiders? A director or a senior officer of the company, a person who has more than 10% ownership, a director of a company who owns more than 10% in a company, a reporting issuer, for example an auditor or an investment bank, it's also called as insider. So this completes module 11. So quickly I'll be doing module 12 also.